So the next moving average that we are going to look at is the 20 SMA. Okay, so when it comes to setting this moving average up, you need to key in the period shift, same thing. Okay, so for the period you put in 20, then the shift you put it as 0, then MA method put it as simple, apply to close. Then for the color, you can use any color that you want. For me, I just use white and then dotted line. Okay, so why is it so important for my trading plan? Because the SMA helps me prevent trading into reversals. So what do I mean by that? That's one very important principle of 20 SMA that you need to take note of. Now I know that many different traders use it for different functions, but I just use it mostly as an additional filter and also for me to prevent trading. Okay, so I never use 20 SMA to enter also. Because for moving average, remember we don't use moving averages for entry. We just use it as an additional filter. So one very important thing that I realized for 20 SMA, okay, you see this white dotted line here? This is my 20 SMA. Then this black line right here is our 100 SMA. So you can see that this is pound yen hourly time frame. This one section here is 1 day because it is an hourly time frame. One column here is 1 day, then this the other day. Okay, so one very important principle that you realize. If you look at how the price interact with the 20 SMA every single day. Okay, for this chart right here, you see that there are 4 days. Of all these 4 days, you see a common thing happening. Is that the price would always have to touch 20 SMA for that day. Okay, you look at this area right here. In the morning, it came back down and touched 20 SMA in the bullish trend. Okay, in a bullish trend. Then the next day, you see the same thing happening again. The price touched 20 SMA. Of course, in 1 day, it can touch many times. Like for this day, 1, 2, 3, and 4. Then the next day again, you see that it touched 20 SMA early in the morning. Then this day is a Monday. You see that in a bullish trend, the price is going upwards, bullish a little bit, but then because it hasn't touched 20 SMA for the day, it came back down and touched 20 SMA and it crosses it, okay, one time. Let me give you a couple more examples. Let's say if I change to euro dollar, okay, same thing, hourly time frame. Let's look at this day first. In the bearish trend, the price is going down. Then after that, it shot back up straight away to touch 20 SMA. Okay, same for here. It touched. Then on Monday, it touched again. Of course, it touched the second time again. Then for the next day, then the next day, touch here and here. Next day, touches again. For this day, it is on a bullish trend. But then again, it shot back down straight away, very fast, to touch 20 SMA. If you have a buy signal here, let's say for example, a momentum signal or breakout signal over here, you wouldn't want to buy over here because you know that for this day, it still hasn't touched 20 SMA. So it has to come down and touch 20 SMA before it goes back up or go back down again. And if I have a signal here, I wouldn't enter. Okay, it touched 20 SMA for this day. Then again the next day, it touched right here and so on. So that's why I say it helps you prevent from trading into reversals, because very likely a lot of people have a buy signal somewhere over here because it is in a bullish trend. But personally, I wouldn't buy because I know that it has to come back down here to touch 20 SMA. So if my stop loss is somewhere here, I would have get stopped out. And of course, you have to look at the hourly time frame and also H4 time frame if you are a day trader. Now if you are a longer term trader, let's say position trader, you look at higher time frames, H4 daily or weekly. Okay, personally for me, I look at H1, then I also look at H4. I want to make sure that for this week, it has already touched 20 SMA. If it hasn't touched yet, I would be a little bit more cautious, because you can see again right here, the price is going on a bullish trend, bullish, then it shot back down straight away to touch 20 SMA. Then next week comes, it touched earlier in the week over here, so we wouldn't have to worry too much about it. It's only for this week, while we're trading somewhere here, we need to be a little bit more careful. Okay, these are good trading weeks where it already touched early in the week on Monday, Tuesday. Then next week it touched here and here and here also. Then for this week it touched later on in the week. Okay, probably around Friday, Thursday. Okay, so when I'm trading at this period, I would need to be more careful from Monday to Thursday, because it hasn't touched 20 SMA for the week. Okay, the same thing for next week, again, and then again. You realize that every single week it has to touch. Same thing for hourly time frame. Every single day it has to touch at least one time. Aside from preventing you from trading into reversals, it also functions to help you increase the probability of your trades. So doesn't this counter the first function in a way? Like, it prevents you from trading, but then it also increases your probability of getting a trade. So what does this mean by that? So the first function in preventing you from trading into reversals is that, let's say for example, euro dollar, we look at H1 time frame. Let's say if you have a sell right here, or here, or here, you wouldn't want to sell, because you know that for this day, it has to retrace back up. And then if your stop loss is right here, you'll get stopped out. Meaning that in a sell trade, when your 20 SMA is above your candlestick, you need to be careful. Then for a buy trade, when your candlestick is above 20 SMA, you need to be careful. But on the second function, what do I mean by increase your probability of getting into trades? You look at this time frame. Right now, the candlestick is above the 20 SMA. Because previously, the candlestick is below 20 SMA. On this day, it is above 20 SMA. So if I have a sell trade here, I would sell. Okay? Because why? I know that the price has to go down and touch 20 SMA. So the price eventually did go back down and touch 20 SMA. So this gives me an additional filter that, okay, this is a good sell over here. But then again, we don't rely on 20 SMA to enter. Okay, we only use it as an additional confirmation. So at this portion, it will be a good place to sell. So this explains function number 2. So when it comes to buy trade, again, function number 1, you wouldn't want to buy when the candlestick is above 20 SMA. Okay, because you know that it has to retrace back for this day. Okay, remember this is the start of the day, the period separator. But for function number 2, how does it increase your probability of getting into a winning trade? When in a buy trade, your candlesticks are below 20 SMA. You look at this day. If you have a buy signal here, you would know that very likely the price is going to go up, because it has to go up for today to touch 20 SMA. And the second convincing factor for you is that this is our 100 SMA, correct? Remember, for the 100 SMA, the function of it is a dynamic support or resistance. So in this case, very likely, the price is going to bounce off from the 100 SMA. So it gives you 2 reasons to go into a buy position. Okay, and of course it did. It bounced off 100 SMA for this candle. Then it went back up and touched 20 SMA. Okay, but for this day, I want to wait until it touched 20 SMA. Then potentially I can buy somewhere here, provided that there is a signal. Okay, so make sure you combine what we have learned so far together. Okay, apply everything together. First criteria is to make sure that you are trading along with the trend. So in this case, candlestick is all above 100 SMA. Then sloping upwards. Okay, then it's a good buy. Then you look at 20 SMA. Now I know it's a little bit confusing when you first start off. Should it be above or below? But once you have practiced and back tested it, it will be very natural to you and very fast, very quick for you, okay? So don't worry about it if at first you feel a little bit confused. It's just part of the process of learning.